Welcome back. So for the next 15 to 20 minutes, we're going to take a little case study from the Spencer family. We're going to go through some of the financial information that they've collected over their prior years of working. And we're going to see where the information that they've collected that relates to their salaries, their other income, deductions, tax credits, we're going to see where those things fall on the actual 1040 form. So we'll go ahead and get started here. So we're presented with some information, and this is kind of how your midterm is going to look. It's going to be in a case study format, very similar to the assignment that you have due next week. But you're going to be given some information around a family. So in the case of the Spencer family, we can see that they paid $15,000 in federal taxes last year based upon their withholdings from their earnings statements. We can see that they had gross wages, W-2 wages of $125,000. They earned $3,000 of interest from their savings account at the bank. They earned $4,500 of dividends from their investment accounts. It looks like one of them has a small business on the side because they had $2,500 of business-related income. And it looks like they may have a rental property because it shows that they have rental income in the amount of $5,000. They contributed to their health savings account. So that is a pre-tax account where the monies can be used for pretty much anything related to your health and wellness, so from co-pays to Tylenol to other medical items that might be necessary, but it's all paid with pre-tax dollars. They contributed 10% of their salaries to their retirement plan, so they contributed $12,500 towards their retirement plan. They made a $6,500 contribution to their traditional IRA. And they paid $1,200 in student loan interest. Okay, so how does all of this play into the 1040? Well, let's take a look. So here we have the 1040 form, and this is out there posted to our learning management system, so you can see it. So let's just go through it. So they're going to file jointly, married filing jointly, so they've selected the married filing jointly box. We've got first name, last name for both William and his wife, Catherine. They've got their social security numbers. Okay, we've got our address. We've got whether or not they would like to contribute to the next presidential election campaign. Okay, doesn't change your refund, but if you would like the IRS to contribute money to the next presidential election campaign, then you can select the box for either you or your spouse. It's $3. Okay. The standard deductions, in this case, no one else can claim either William or Catherine on their tax returns, so there's nothing marked there. They're not born before January 2nd, 1955. They're not blind, and neither was the spouse. Okay. They have one dependent, Victoria. Okay. Their child. Right, so this is just all kind of information related to the people, individuals who are filing the taxes and any dependents that might exist within that household. So now we get down into how we go about filling out this tax form. Okay, so the first line item 1, relates to the W-2 earnings, the wages that come off of box 1 of your W-2. And in the case of the Spencer family, okay, that amount was $125,000. Okay, and then we just kind of work our way down the line, right? They had taxable interest, okay? That was their savings account that had earned interest at the bank. That interest is taxable. So that was $3,000 of taxable interest. Moving our way down the line to ordinary dividends, okay? They receive dividends from their investment accounts in the amount of $4,500. So the ordinary dividend amount goes in that line item. Okay. Now, we don't have anything related to IRA distributions, pensions and annuities, no Social Security benefits. We don't have any information related to any sort of gains or losses on their investments throughout the course of the past year, so nothing goes there. Okay. Now we're moving our way into line 7A, and now this says other income from Schedule 1, line 9. All right, so that tells us at this point, we got to go to Schedule 1, which is also posted to the Learning Management System portal. So let's go to Schedule 1. And here's what Schedule 1 looks like. Okay, so Schedule 1 gives us information related to any additional income and then subsequently any adjustments to our income. Okay, so we know that we had some additional income from the Spencer family because it told us they had rental income in the amount of $5,000 and they had business income of $2,500. So business income is line 3 and rental income, okay, is line 5. So we had two sources of additional income. So line 9 just sums everything else above it. So $7,500 is the total adjustments to income that the Spencer family had. Now, where does that $7,500 flow to on the 1040? Well, let's go back to the 1040. Okay, and there it is. Line 7A, other income from Schedule 1, line 9, which we just calculated as being $7,500. Okay, so we have our initial sources of income from our salaries to our taxable interest to our ordinary dividends. We have the additional sources of income. When we add all of that up, we have our total income for the Spencer family of $140,000. Now we've taken care of all of the income. Now, let's go look at line 8A, the adjustments to income. What can we deduct from our income in order to get to our adjusted gross income? And it tells us where we need to go, Schedule 1, line 22. So we're going back to Schedule 1. And we can look through to see, well, what adjustments to income do the Spencers have? Well, look, line 12, health savings account deduction. We're able to deduct that from our earnings, $1,500. Line 15, self-employed, SEP, simple, and qualified plans. Okay, qualified plans are the retirement plans that are associated with things like 401ks. Right? So this is where the retirement contributions goes, $12,500. They made an IRA contribution, so line 19, $6,500. Line 20, student loan interest deduction. They paid $1,200 in student loan interest and they're able to deduct that as an adjustment to their income. So when we sum up all of the adjustments to income, we can see that the Spencer family, row 22 of Schedule 1, have $21,700 of adjustments to their income that then flows to line 8A on the 1040. So here we are, 8A, line 8A on the 1040, and there it is, $21,700. Okay, we brought that over as an adjustment to income from Schedule 1. Basic math, we take income minus the adjustments to get to our adjusted gross income. So the Spencer family AGI is $118,300. Okay. Now, line 9, here we go. Standard deduction or itemized deduction. We're going to do the standard. So we look over here at this flyout and we look for their filing status. They're single or married filing separately. Nope, that's not them because they're married filing jointly. And then here we go, married filing jointly or qualified widow, widower. Okay, so they're married filing jointly. So they get to deduct the standard deduction of $24,400. So line 9 is the deduction that they're going to take. That is the standard deduction. Okay. Line 11A is simply the sum of 9 and 10, and since there's nothing in 10, they are claiming the standard deduction of $24,400. Okay, so remember, adjusted gross income minus deductions gives us taxable income. Okay, so when we take $118,300 and we back out the deduction, the standard deduction of $24,400, our taxable income that we've calculated for the Spencer family is $93,900. Okay, and this is the number that we then go to the marginal tax tables for to determine what their actual tax owed looks like. Okay, so let's go do that. Okay, so here we are in Excel. Our taxable income of $93,900. Now we got to go to the marginal tax calculation. Okay, so remember, when we go back and we look at those marginal tax tables, it's going to tell us what marginal tax bracket we find ourselves in based upon the taxable income. Okay, so when we look at the marginal tax table for married filing jointly, we can see that the $93,900 falls in the 22% tax bracket. And now all we have to do is calculate the tax based upon the layers. So for the first layer of tax calculated, okay, we take the full bracket. So the 10% tax bracket with married filing jointly is any dollars earned from $0 to $19,400 are taxed at 10%. So 19,400 minus 0 times 10% gives us our first layer of tax of 1940. Okay. We get the full impact of the tax within the 12% tax bracket. So the range there is 78,950 to 19,401. We're taxed on that entire difference at 12%. So when we do that math, the tax in layer 2 is 7146. And then finally, we're in the 22% tax bracket. Therefore, it is the difference between our taxable income of $93,900 minus the lower end of that particular tax bracket range, which is $78,951. So we're taxed on that difference between our taxable income and the start of that marginal tax bracket. We're taxed on that difference by 22%. And when we do that, we get $32.89 as our third layer of tax. So we sum up all three layers of tax for the total tax that we owe marginally of $12,375. Okay, so $12,375 as we move through the 1040, we can see that the tax that is calculated that we owe flows into line 12A. And there you have it, $12,375. So when you calculate the marginal tax that's due, that goes in line 12A. Okay? It has nothing to do with what you've already paid. It has to do with what you owe based upon all your other sources of income, the adjustments to income, standard or itemized deductions, taxable income, and then the marginal tax calculation. Okay. So we don't have any child tax credits, all right? So when we get to hit down here to line 14, it tells us subtract line 13B from 12B. So 13B is 0, so therefore line 14 is $12,375, only the tax that's owed. Okay. We don't have any other adjustments to income, okay, to the other taxes, excuse me. So therefore, our total tax that we owe is $12,375, right? We did it. Right? We used the marginal tax tables to calculate how much tax was owed based on our taxable income. Now, line 17, it's asking how much did you have withheld from your paychecks from your W-2? Well, in the example, we were told that the Spencer family paid $15,000 in federal tax from their earnings statements, okay? So they already paid $15,000 of whatever tax bill that they were gonna have for the tax year. Okay, so they paid $15,000. Okay. They didn't have any other earned income credits. They had no child tax credits. They had no American Opportunity Tax credits. But remember, we talked a little bit about some of these other credits that we might be able to take advantage of, okay, like the electric vehicle credit, okay? So they told us, or I'm telling you, that they bought a Tesla last year and they got a $3,000 tax credit. So that tax credit flows through line 18D, okay? And if we wanted to go to Schedule 3, we could look at it, and this is what Schedule 3 looks like, right? But credits from other EV credit, 3,000, okay? So that's where we put the 3,000 on line 18D back on the 1040. There it is, 3,000. Okay. We add up 18A to 18D, and that's what goes on 18E. Okay, and then we calculate our total payments. So we had the 15,000 that we paid from our earnings statements, from our paychecks. We get to add the tax credit that we received, 1 for 1, remember that. So in total, we would have paid a total of $18,000 in tax last year, okay, when what we really owed was $12,375. So on line 20, okay, if line 19, 18,000, is greater than line 16, 12,375, then this is the amount that you overpaid. So we take the difference between 18,000 and 12,375, and we calculate that the Spencer family should receive a refund of $5,625. Okay, if the difference, okay, is what you owe, so the amount that you owe, if 19, okay, is less than 16, then you owe money in row 23, okay? And in that point, you're writing a check to the IRS. So at this point, we're finished with the Spencer family, okay? They're gonna get a nice refund of $5,625, okay, into their checking account that they're going to be selecting, or their savings account. But you put your routing number and your account number, and you're done. Okay, and then don't forget to sign the return, both of you. In the case of the Spencer family, William and Catherine both need to sign the tax return, or else it will get rejected. Okay, so there's the summary on how we go about building the actual 1040 based upon data that we're provided, okay, which you will be provided all of the data that you need in order to fill in the 1040 form. Okay. So your assignment is to read the case study that has been posted to our learning management system, okay, and answer the first 7 questions that relate to determining the adjusted gross income, the taxable income, the marginal tax that's due, okay, and figuring out whether they're going to get a refund or whether they're going to have to owe money to the IRS. Okay, if you have any questions, I'm available at any time. You can call me, text me, email me, whatever is most convenient for you. If you need more advanced support, we're happy to hop on Zoom for a Zoom call at whenever you need. Okay, I hope that everybody has a great rest of the week, and look forward to seeing you next week. Have a good one.